Hi everybody, welcome to this week's Best Bits. I thought rather than forwarding somebody else's data information to this week with a comment, it was time I did another video and they seem to go down well. I'm sorry about the haircut, don't give me a hard time for those who have been. It's for a good cause and we're getting there. Now I just want to cover off really what's happening with property right now, because it's a really interesting time, it's a fascinating time right now, and it is the old thing that Warren Buffett always talks about, you know, when those who are fearless, be fearful, when those who are fearful, be fearless. And what I'm seeing now, as you know, I've held back my investors over the last 3 months while the uncertainties surrounding COVID were apparent, and now we're seeing a lot of certainties come back in where we can read what's happening in the marketplace much more clearly. A lot of the rental side of things and all those sort of things we're focused on with our investors have settled down. People are now educated. If you've still got some questions on that one, by all means message me. But we're seeing now the marketplace is becoming quite clear. Where Australia is at with COVID is quite clear. And as many have pointed out in the past, if you've been listening to some of the specialists out there, these times are great for property. This is when property seems to be the most stable, solid, reliable investment resource for people in this age. So many other things are uncertain. Property remains really reliable through this time, and you'll see in history when there's been depressions and recessions and financial dramas, property has been the steady and right through, and actually has gone well since. So interesting times, and you'll read the newspapers a lot and the media, and what we always seem to remind people of is that the media you get on your TVs and your newspapers and radios, etc., is largely coming out of Sydney, and you'll often hear people talking about the Australian property market. As I've always said, there is no Australian property market at all. There are states, there are cities, and there are pockets within those cities. It all changes, and each city has its own cycles and methods and reasons why it moves at a certain time. We've covered it in the past. I won't bore you with that, but I will talk about that in a little while. Now, I just want to get through this fairly quickly without rushing too much, so I'll break this down as simply as I possibly can. What we're seeing in the marketplace right now is a lot of activity. Now, I've held back clients from investing up until about 3 weeks ago, and I've said, okay, the lights have come on. And interestingly enough, it's been the experienced investors that have come on board, all right? So those who have bought property before and understand the property market and don't have those fears are realizing, like Warren Buffett said, he's not changing his overall philosophy for this time period, for COVID or whatever else. He's looking at a 10, 15, 20-year time period for his investment. And that's still the case when it comes to serious property investors. As I've always said, there's 3 reasons why people buy property. It's to live in, it's to make money from, or it's to create wealth. What we're talking to you today is about the wealth creation. You can buy and sell and do what you like, that's making some money. We're talking about wealth creation strategies that require you to get 1, 2, 3, 4 or so properties. I don't talk 10s, although some clients do, but 4 properties can be enough, and my job is to get you there, and that'll give you a reliable income if we get this right for retirement. Now, what's in the marketplace? Media. Media's talking about Sydney, so don't confuse that with your local zone. All right, and it's going to be the case over the next 3 months, 6 months, and you get lots of speculation and lots of negativity in the marketplace. That marketplace negativity is media driven. And we'll see that for certain reasons. I've got my own thoughts and opinions, if you like, based on, of course, many years on what's happening in Sydney and Melbourne and Brisbane. I'll touch on those in a moment. But overall, we've got to look at about what's happening for you personally and then what's happening in the marketplace. So negativity is media driven, and it's not referring to you. It's referring to what gets in the headlines at the time. The other side of that is the optimism. Now, I'm always happy to be optimistic and positive when it comes to property, but the spookers and optimists out there, again, they're more right than the negativity because they're talking about history and data and so forth. Those things are very important. But again, they're looking to try and sell things, the optimists that have been out in the first 3 months of COVID. Now, I'm talking about we want to make sure we get a rational, reasonable response to this, which is really to be continuing your vision for your wealth creation over a period of time, and then how to maximize your situation through this and keep yourself safe at the same time. So optimism has a place, but largely it's those who are trying to sell something at the time. Now, it's actually opportunistic time for people if they're in a strong situation and stable situation and can go get property. So I want to talk to you today about the realism. So where are you at? What's the real situation in the marketplace? And it's interesting right now. We're seeing those who want to be negative about the 25 grand grant that the government's dished out. Don't want to play the negativity or the politics at all. But what we're seeing in the marketplace this weekend, we're seeing people hitting the ground when it comes to putting EOIs, expressions of interest, on property for buying their own home or for upgrading, etc., because it's not applicable to investors, but it has actually activated the marketplace. recently and especially this weekend. What we've seen over the first couple of months, it's interesting in property. My phone's about to, here we go. My phone's about to lose its sticky, so there you go. So what we're seeing in the marketplace in real estate, which is different to property investment, in the real estate market, people haven't been putting their properties on the market at all. So there's been less listings and more buyers have been still active out there. So it's been a seller's market. This current time frame, the past few weeks, the next couple of weeks, we're seeing a lot of people change and people's houses are hitting the marketplace, all right? So in the space of 3 to 4 weeks, we'll see a seller's market shift to a buyer's market. Now, as a property investor, it shouldn't really change where you are. For some who are the inexperienced, who are the people that really just buy one property because they make a mistake and don't fully understand the detail and the data and the maths, they might look for an opportunity. So yes, for the opportunistic people, there'll be opportunity to buy a property at bargain price. Bargain price being 10% maybe below or whatever. But just remember, if you're buying investment property and you're buying a bargain, it's a bargain for a reason. It is not going to fit your ideal product. So you've got to work out what is the ideal product for yourself, investment property wise, and then you focus on getting the best deal around that, and then continue a deliberate strategy and a path forward. Okay. So we're talking about the realism. So in the marketplace, the realism is that we're seeing buyers come back in the market. We're seeing some activity on sellers, and already out in the marketplace, certainly in Brisbane, we're seeing expressions of interest go in. A friend of mine who was doing property the weekend, they normally get 15, 16 per day. They were getting 30 and 40 groups coming through per day. So activities out there, regardless of what you may or may not hear in the media. So when it comes to property investors, why are we getting excited now? Why? There's never been money that's cheaper in the marketplace than today. I remember when investment loans were coming under the 5% market and we're seeing interest rates under 5%. I thought we haven't seen that in 55 years. Then we saw the 4%. We're seeing 3%. And right now we're seeing 2-point-something% on interest rates. Now money's never been cheaper, but it's probably never been harder to get. So the servicing side on the banks post the Royal Commission is tougher and tougher and tougher. So it's never been cheaper, but it's never been harder to get, which is why you need to make sure you're talking to a good, solid professional broker. So what am I talking about this with excitement and zeal? Well, when it comes to money, I'll give you an example. In Brisbane, and I use Brisbane for a reason, but in Brisbane right now, you can buy a property for 500, you can get one for 400 or 380 even if you like, it depends where you go. But let's use this example of a $500,000 investment property. You can get this sort of number, a 3% interest rate. You can get 3 point something. I saw one last week at 2.09% for 2 years fixed, all right, for an investment P&I loan. I saw one of those. And so they're out there. So you get 2 point something. But let's talk about 3% because I know we can comfortably have brokers who can find loans around those sort of prices for you. So 3% interest on a 500 grand property. If you borrow the whole lot, for example, plus even some costs, you're looking at an interest bill per year of $15,000, right? Throw some costs in there, your insurances, your rates, your body corporates, or no body corporates hopefully, but your property management fees and others. You're looking at $6 grand conservatively, so that property might cost you 21 grand per year. Simple raw numbers and maths, all right? 21 grand cost per year. In Brisbane, that's why I'm looking at Brisbane particularly, your yields are up, your 5% yields roughly, all right? So you can get $500 a week for that property, but let's call it $450 per week. And only $450 conservative, let's say, what's that getting us? 22.5 grand per year. So already we're $1,500 per year cash flow positive before we start talking about tax and negative gearing aspects that might come in and help you. So you can probably pick up another 5 grand. So quite comfortably, you can get a property, a basic property, and you're $100 per week cash flow property positive. You can use your equity from your own home, so you're not outlaying some money straight away at all. So these are the raw numbers that get me excited on why people who can afford to buy property and are safe should be jumping in and doing something sensible now. And of course, where do we want to go? Are we going to Sydney? Not really. Sydney had a great growth spurt, went between 2012 and 17, got up to a great new plus $1 million median price for houses. We had the Royal Commissions come in, the bank come in, APRA come in, whole pile of reasons why they had to curb some aspects of it, and it damaged the whole country, and Sydney then popped down about 15, 16, 17%. And it found its new base level. So Sydney now base level hit that, and then it went back up again beyond its base level. And I believe over the next 12 to 18 months, Sydney will come back down to that base level again. So it might drop again another 10, 15%. But as I said before, there are pockets within pockets. So some areas of Sydney, like some of the Bondi areas and the high areas that are affected by tourism, are going to be problematic, all right? Areas like the Shires and Cronulla's and North Shores and many of those other areas won't change a jot to do with the corona side of things. So pockets within pockets. Melbourne a bit the same. Melbourne will be less affected. Sydney you might see a 15 or even 20% change across the board in areas, but I don't think it'll be that bad. Melbourne, if Melbourne might be something similar, but probably more than 10 to 15% because of, again, its base level didn't drop down as much either. So it's dropped down, it'll drop down another, but to its new base level, and I think you'll find in another 2 years' time it'll be back up again. So again, properties for long term, not for short term of these things. So again, I'm not looking at Sydney right now for property investors. I'm not really looking at Melbourne either, although there's some areas and some great pockets there. You can get properties under 500 grand in Melbourne that are, but the yield's not quite there for those, okay? So not looking at Melbourne ideally because the opportunity in Brisbane right now is fantastic. We saw Brisbane values increased by 1% in the month of February before Covid happened. The same factors and the factors surrounding the infrastructure spending between the government and private, the employment status and so forth, all the reasons that were causing Brisbane to run. It hadn't run, it was we've been waiting and waiting and waiting, it's been stretched back for this time, it's now running, all right? So as soon as it started to run, Covid happened and it pulled it back. So I don't believe we're going to see much damage at all done around Brisbane. Gold Coast, another story. I live in the Gold Coast. It's going to be a bit of a bloodbath when it comes to the rental market, come post-September, etc., I believe, and that'll kick on for another year or so after that. So I've always said avoid Gold Coast for investment property, and now there's some really strong reasons why you should. Brisbane, on the other hand, there'll be some pockets in there, there'll be some city areas that I don't like, West End, Fortitude Valley, perhaps all those sort of areas, don't really like them. Don't like apartments, of course, anyway. They're the ones that are being damaged. But you'll see some great areas in the 10 to 20k ring around Brisbane, which are really opportunistic side, where you can get properties around that 500 grand mark anyway. So what am I talking about? I'm talking about investment property. I can share with you the stories of the market and give you my opinions like I just did. But overall, investment property is a smart way to go long term, and those factors haven't really changed, except money's never been cheaper. So you can get yourself into investment property for bugger all really when it comes to 3% interest rates or thereabouts. Even if you're paying 4% interest rates, you're still cash flow neutral or cash flow positive before you then go sucking the benefits out of negative gearing side of things as well, which would really just be a bonus to help you. All right, and the capital growth we're expecting for Brisbane will sort of outstrip Melbourne and Sydney over this time. So I'm talking about jumping into Brisbane mostly for most of my clients. These are the factors around a 4-bedroom house. If we go to a dual key type property, it goes through the roof. You're talking $200 a week cash flow positives, all right? So that's some quick thoughts for today, and it's not as quick as I want it to be. I talk fast. So if you didn't quite get all that and you want to find out some more, make sure you message me, email me at mike@onyoursideinvestments.com.au. I'll get back to you with your story because each person's scenario is different, and the solution, strategy, etc., and the help given will be different for you too. So hopefully you've got something out of that. Again, message me and please share this message. Cheers guys, bye.